Richard in St. Thomas, Ontario. Go ahead, Richard.
Good afternoon, Mark and David. I'd like to ask David about KKR, if this is a good stock to play on the U.S. financial services.
Sure.
Thank you.
So Richard, let me take it from the top in the way that we look at the world. Ultimately, we try and get focus in geographic regions that are seeing an uptick in money getting put to work or expanding breadth in the market. U.S. market is probably the best globally for that. There's about 75% of the stocks in the U.S. market participating in this rally. The second piece is when we drill down to the sector level, we're trying to find market leadership, areas that can be revalued based on changing fundamentals and positive price characteristics. The financials are a group that are seeing money flow in. We're seeing expanding breadth across money managers, banks, and insurance companies. Then let's get down to the individual business. I want to find companies where something's changing for the better. KKR is a private equity manager, have made all kinds of investments over the last few years. We're in a decent equity market. They have opportunity to monetize some of their deals. And I think that you are going to see more of these private equity deals get monetized as we go forward. So as equity markets get better and as valuations get better, their management fees improve. I think you're in the right sector. You've got a company that's well managed and certainly has great assets. And the valuations on those assets are getting better. So long as we have this easy monetary policy that's supporting asset prices, I think KKR is probably a great investment.
So this is maybe one of the better times to buy something like this, as opposed to in the early days when they're snapping up distressed companies and then several years down the road looking to sell them off.
Right. I mean, we are at the point where the market's willing to pay for this. At the time when they're making their investments, very often the market's looking at them saying, wow, these seem like risky investments. And very often, they are when they're making them. But they're getting, a lot of these private equity companies are closer to harvesting some of these investments, and KKR should be a beneficiary of this market.
Okay, then here's Kevin, who's in Peterborough, Ontario. Hi, Kevin.
Hi, thanks for taking my call, guys.
Sure.
I just wanted to ask you your opinion on Crescent Point Energy. I'll hang up, and thanks very much.
Thanks,
Sure. So Kevin, I'll take the same tact here as I took on the last question. Canada as a market is a less attractive market currently, and we have traditionally had lots of assets in Canada, but the Canadian market is very narrow breadth. There's several sectors that are not participating. One of those sectors is the energy group. So outside of some very specific players with assets in parts of the market that have a net advantage, either very low cost production or there's very strong production growth, the Canadian energy producers are having a tough time. So Crescent Point, as one of those, has opportunity to grow. Certainly they have lots of targets to drill. They do have the advantage of being a yield payer. They get a little better valuation. I think, though, right now the sector concern is overwhelming it. So I think market and sector kind of against you right now, and Canada largely in general with the resource focus. I think I'd look in other places.
In Kelowna, we have Dean on the line. I have the feeling he knows that John likes this company, or David likes this company coming up here. Go ahead, Dean.
Well, thanks, Mark. Dave,
Sure.
You always make so much sense here. It's hard to see you here for only half an hour. If you were going to buy, which you like best, American Tower or SBAC?
Okay.
Thanks.
Well, that's a tough one. So both companies, SBAC and American Tower, for those that don't know, are real estate investment trusts that own mobile towers, cell towers, all across the U.S. and in Latin America. In the case of American Tower, basically you're buying a REIT, and you're buying a fairly quickly growing REIT. Now, as a sector, the REIT sector has pulled back over the last 2 or 3 weeks as you got 10-year bond yields move higher, right? Higher long-term rates not generally good for this group. Having said that, this is one of those companies I talked about. It's going to be a dividend grower, and you're going to get above REIT sector growth in this company. I think I would be happy owning either American Tower or SBAC. You will notice over the last couple of days, you've seen a little bit of a pullback in the more economically sensitive sectors, and you've seen a reaffirmation of strength in some of the REITs. I think this is an excellent entry point for either American Tower or SBAC.
Looks like a healthy pullback there. And David says you can buy in right at this level. John's in Chilliwack, BC. Go ahead, John.
Thanks for taking my call. Just wanted to get your take on News Corp before the split. Is it worth buying it for the split? And maybe you get a bit of your take on it.
Sure.
Thanks very much.
So News Corp in the media group I think is very interesting. If you look at the common characteristics of some of the leading groups in the market over the course of this year, healthcare, which includes pharmaceuticals, some of the media companies, some of the real estate investment trusts, these are all companies that have pretty predictable cash flows. And the media sector has very, very strong predictable cash flows. News Corp has a bunch of different pieces. You're going to see a split. I would own it before the split, not after the split. I purchase it now. And there's a very strong theme in place underlying. I like the media group as a whole, and I like the U.S. market.
Do you hold News Corp?
We don't own News Corp currently.
What about Disney or some of the others?
We own Disney, and we're going to, if we may have an email later on one that I was told, but we like the media group as a whole.
All right, next up we have Mariana, who's in Mississauga, Ontario. Hi, Mariana.
Hi, Mark. I'd like to get your opinion on CIBC. They just raised the dividend and reported better than expected earnings, but the stock has lost around $2 per share in the last few weeks. Can you explain why?
Sure.
I'll hang up and listen. Thanks.
Mariana, very often when you make an investment in a stock, you're not buying necessarily what you have today, but what the market is looking at going forward. And for the last few months, you've seen Canadian banks underperform and U.S. banks outperform. So U.S. banks not only outperforming Canadian banks, but outperforming U.S. market, and of course U.S. market is outperforming Canadian market. So what's happening? Canadian banks held up their value very well through the decline we went through in 2008 and 9 because we didn't wind up in difficulty. Very well run, very conservatively run. Having said that, we're now at a point where the Canadian economy appears to be slowing down a little bit, driven by a little bit of slowdown in housing, a little bit of slowdown in the consumer. On the other side of the border, you've got a housing market that is slowly showing some improvement, and you've got consumer confidence improving, retail improving. So on one hand, you've got a company where the outlook is dimming just a little bit for the industry, and in the U.S., you've got some net improvements. U.S. banks are cheaper than Canadian banks. People have paid high prices for Canadian banks for that quality. But if things are getting a little worse in Canada, a little better in the U.S., and you can buy U.S. banks cheaper, they're paying out less of their earnings, you could see a rise in dividend yield. I'd prefer to go to a U.S. bank. And what's happening, sadly, is that many international investors are pulling money from the Canadian market and looking in other ponds to go fishing.
Let's stick with banks here, both sides of the border. Here's Larry, who's in Minden, Ontario. Hi, Larry.
Hi, good afternoon, gentlemen. Actually, this is a continuation of what the last caller was discussing, and I had CIBC in mind. Dividend yields 4.9%. I look at American banks. Bank of America, they pay 1 cent per quarter in dividend, trading at 40 times earnings. Citigroup, trading at 19 times earning. They pay 1 cent per quarter dividend. They might as well pay zero.
Right. So what's the direct question, Larry? We have to get moving here.
My question again is the same as the last caller. I guess comparing the U.S. and Canadian banks. Sorry to interrupt, Larry. We got to go, but dividend yields.
Okay, so let me answer that question directly. The U.S. banks have been held back on paying dividends by the Fed while they rebuilt the capital in the businesses. They've done that over the last 3 years. Loan losses have come down, and now the top 50 banks are paying out less than 27% of their earnings, where the Canadian banks pay over 40%. So you are going to see the Fed release them from that harness, allow them to start increasing their dividends, and so the market, I believe, is willing to pay a higher multiple going forward for U.S. banks than Canadian banks, and right now, on a valuation basis, they're cheaper.
And one of your top picks is a big U.S. bank. Stick around for that. That's coming right after this break.